Okay, thank you again for joining us today. Again, this webinar is regarding accounting for leases under ASC 842. I'm going to go ahead and get started on our presentation in just a minute. Let me go ahead and go through some housekeeping items here regarding the webinar and the CPE credit. All attendees are placed on mute, so if you do have a question, there is a question feature on your dashboard. If you want to go ahead and type those in, we will be collecting those throughout the presentation. We do have a lot of material to get through today, and Charlie will go through that. So if we do not have time to get to your questions, we will follow up with you regarding those questions after the webinar this afternoon. You will receive a recording of today's webinar along with the slide deck following today's webinar. So again, there will be a lot of information, but you'll get those materials either later today or tomorrow. Regarding CPE, for those of you who are seeking CPE credits today, please note that you must answer all 3 poll questions during the presentation. Those will pop up on your screen. You do not need to answer correctly, though I don't believe there's correct answers to today's poll questions, but you do need to submit an answer. Those who qualify for CPE will receive their certificates via email. Please look for those in the next few days. Also, for all attendees, a survey will appear on your screen following today's presentation. We value your feedback on how we can make these webinars as meaningful as possible to you, so we do ask that you spend a couple minutes filling those out. It would help us greatly. So with that, we'll go ahead and get started. I'll introduce today's presenter. Charlie Murphy is a senior audit manager here at Richey May. He specializes in the mortgage industry, and he's been doing a lot of work and studying up on accounting for leases. So again, he's got a lot of material to present, and with that, I'll turn it over to you, Charlie.
Great, thanks, Rachel. As Rachel mentioned, I have been sifting through thousands of pages on ASC 842. Whether it's Big Four, regional firms, local firms, vendors, people with opinions in general. It covers everything from overviews to the finest details of the guidance. So we do have a lot to get through today. As the title suggests, we'll be focusing the next hour on the new lease guidance, specifically as it pertains to lessees and primarily in the mortgage banking space. So we're looking at real estate leases, equipment leases. So what this presentation is not, we will not discuss lessor accounting. We may not touch on every unique scenario that is specific to only a handful of users. Each of you have your own needs and desires from this webinar based on your own facts and circumstances. So in that case, please submit your questions on here or to Rachel or myself directly. We can look to discuss offline. If possible, we'll compile an FAQ at a later date and distribute that to everyone as well. So if there's enough interest, we can also look at setting up, call it a lease accounting 201 that will specifically walk through real world examples and scenarios. So with that, we can kick it off.
All right, we're launching our first poll question. You should see that on your screen. You can go ahead and select an answer. We'll give you about, I don't know, 25 to 30 seconds. Okay, it looks like most everybody has voted. We'll go ahead and close that poll. We'll share that with the audience here.
So interesting, we've got 42% of the respondents plan to use spreadsheets to track and monitor your leases. So this will be a hot topic as we kind of go through the presentation, some of the difficulties that you might run into. If you've done nothing to implement 842, great, that's why we're all here. Share some of the issues that public companies might have had, and some of the tools you can use to prepare. And a few of you have developed an in-house solution, about 6%. So it'd be interesting to go through our discussions today, and as we circle back around afterward, what sort of issues you've run into or successes you've had that you can share. So we'll continue. So the hope is that I can at least cover 90% of what's universally applicable to everybody. So you are equipped with the key terms, considerations, components of the guidance as you're either rolling out, implementing your own technology solution, whether you're working with a vendor or using spreadsheets. So the overall objectives, we're going to talk a lot about the key changes, of which there are many, whether it's definitions, the criterion, the presentation and disclosure. We'll also talk about how these changes are going to impact your organization. The new guidance will involve a much deeper understanding of all your contracts, not just the equipment and real estate leases. It's going to involve a lot more judgment. Challenges that public companies have experienced. So public companies have gone through their first 2 quarters of the transaction period. So even with resources at their disposals, they've encountered a number of challenges. And depending on what survey you look at, adopting entities have experienced upwards of 25% failure rate. And then what sort of next steps can you implement? So whether you're determined to handle the accounting through spreadsheets, using a software, outsourced accounting, or we're going to consider the points throughout this presentation when discussing internally or with solution providers in setting your tailored approach. As for the effective date, interesting to note, public companies are underway. Non-public entities were initially scheduled to adopt beginning on or after December 15th, 2019. So for calendar year end, that's 1/1/2020. In July, there was an exposure draft that is likely to extend. I can't see why it won't. The effective date appears beginning on or after December 15th, 2020. So we're looking at a Jan 1, 2021 adoption. Early adoption is permitted. Often we'll see that when an entity is rolling into a public entity. While we don't recommend taking advantage of the early adoption, it's there. We recommend taking advantage of the time to prepare. As we'll talk about some of the difficulties, maybe this will equip you with the tools you need to reevaluate through the end of next year and adopt in 2021. Key change highlights. The big item, obviously, is that operating leases are now coming onto the presentation of the balance sheet. So whereas before capital leases were shown on the balance sheet, operating leases were executory agreements and disclosed in the footnotes under a maturity analysis. That's all changing. And we'll look at an example of that. Capital leases, more of a terminology change. These are finance leases. The finance lease criterion have changed. One example is the removal of the bright lines test or the 75%, 90% test, which we'll get into more detail. Management judgment has increased, as we've talked about. The definition of the lease has been updated, and some contracts that previously were not accounted for as leases may now be considered leases. We'll give some examples. I've tried to highlight throughout the presentation any key differences in red so they stand out as we're going through the presentation. So high level, what's happening, we talked about that new right of use asset and lease liability that are now coming out of the book. So whether it's an operating lease or a finance lease, you will now be recording a right of use asset and a corresponding lease liability. And the initial measurement is the lease liability being measured at present value, the net present value of the future lease payment. We'll break down each of those components. And then the right of use asset is measured at the lease liability plus any initial direct costs, any prepayments, and less any incentives received or receivable. Another consideration with this new guidance is that any existing deferred rent immediately preceding the transition is netted against the right of use asset, so that deferred rent goes away. Leases capitalized subsequent to the transition date that don't have initial direct costs, that don't have prepayments, that don't have lease incentives, essentially the lease liability will agree to the right of use asset, at least on day one, and we'll look at subsequent accounting in the presentation as well. So with that, what is the definition of a lease and how has it changed? So under legacy GAAP or ASC 40, It is an agreement conveying the right to use property, plant, or equipment, usually for a stated period of time. Under new GAAP, it is seen as a contract or part of a contract that conveys the right to control the use of an asset for a period of time in exchange for consideration. So, a couple of notable differences. Previously, the guidance pointed to an agreement, and the new guidance will require a significantly more in-depth understanding of all contracts, specifically once you consider your service agreements that are in place. And more judgment is going to be used when assessing whether those parts meet the lease criterion, which we'll talk about as well. Next, the lease was viewed with the right to use. With the adoption of ASC 842, we're going to talk more about the change to the right to control. And lastly, FASB calls out specifically the requirement of the exchange of consideration or something of value. This will predominantly be cash in terms of this group, and consideration will also be a topic that comes up when we start to discuss lease and non-lease components. So how do I identify whether or not I have a lease? So there's flow charts out there. They all look different, but they're all the same. First step is, do I have an identified asset? So a contract or a part of a contract, as we discussed, is no longer the agreement, it's within the agreement for the parts, must depend on the use of an identified asset, which must be explicitly or implicitly identified. And when we explicitly, you've got a lease for a computer, the computer is identified. For implied, you might have a hosting arrangement and the host has a server. That server might not be identified in the contract, but its use is implied. And a physically distinct portion of a larger asset may be an identified asset. So say another floor or a suite within a building is a smaller part of a larger portion. If you don't have an identified asset, whether explicit or implicit, you don't have a lease. One point to consider, however, just quick, is the substantive right of substitution by the lessor or supplier. If the substitution would be considered substantive if the lessor has the practical ability to substitute the asset. It can be easily done. It doesn't cost them an exorbitant amount of money to do it. It doesn't interfere with their operations. And the lessor could benefit from exercising that right of substitution. Then you would not have a lease because you would not have an identified asset. So the next step is kind of a two-parter. Does the customer control the use of that asset? So part one of the two-parter is, does the customer have the right to obtain all the economic benefits from the use of the asset? And in this case, if you're renting an office space, you are controlling the use, you're obtaining the benefits, you are operating your business, your branch out of that space. You control the economic benefits. Does the customer have the right to direct the use of the identified asset? This is looking at, can you direct the how and for what purpose that asset is used? This is fairly straightforward, I think, for this group. But we don't need to dig too much into details, considering we have an hour together. So if you've met the control criterion, then you arrived at the fact that you have a lease. Otherwise, you do not have a lease. Now, are there exceptions as to whether or not I need to include these leases in my determination of my right of use asset and lease liability? Yes and no. So there is a short-term lease exemption. So any lease of 12 months or less, generally it can be elected as a accounting policy election to be excluded from the guidance. There is not an exception for immaterial assets or assets that are not essential to your operation. So the non-core assets. So these assets would be considered non-essential to operations. The FASB had considered including an exemption for non-core assets, but they ran into some issues. One being that it's difficult to truly define what core and non-core is. And companies, whether public or non-public, may have a different interpretation of what core and non-core might be. So there could lead to a diversity in practice and issues for comparability for users of the financial statement. And there is no GAAP definition or distinction between core and non-core purchased assets. for capitalization purposes. So there's no justification for distinguishing the rights in capitalization of core and non-core assets. Interestingly enough, the International Accounting Standards Board came to a different conclusion. They allow for a $5,000 scope exception under IFRS. There's not a specific threshold for GAAP. However, it's still a valid approach to consider the materiality of leases, similar to a cap policy on PP&E. But you should be cautious in defaulting to the cap policy as a rule of thumb. The existing capitalization policies don't take into account the lease liability that's introduced by 842. If a policy is established to set a threshold, it must include the aggregate consideration of the right of use asset and liability that would have been excluded. So you're looking more like a group. Think both purchases of laptops, monitors. One reasonable approach would be to record the lease liability still, but subject the right of use asset to some sort of threshold and expense it immediately, and then the liability would just amortize off through future payments. So I identified I have a lease. I've determined whether or not it meets my threshold. So next step is I've got to classify it as operating or under new GAAP if it's a finance lease, previously capital. So walking through these really quick, and we'll talk about some of the changes. So does the lessor transfer the ownership of the underlying asset to the lessee by the end of the lease term? If the answers are no to these questions, we result in operating leases. I'll just read through. Does the lessor provide the lessee an option to purchase the underlying asset, and is that option reasonably certain to be exercised? The lease term is a major part of the remaining economic life of the underlying asset, and does the present value of the lease payments equal or exceed substantially all of the fair value of the underlying asset? And finally, this is a new one, the underlying asset is of such a specialized nature that only the lessee can use it without major modifications. The lessor expects to have no alternative use for the leased asset at the end of the lease. So again, if the finance lease criteria are not met, the lease is an operating lease. So you'll notice some changes here as compared to legacy GAAP. First of all, the reference to the bargain purchase option at the end of the lease term is gone, so the dollar purchase option. Instead, new GAAP requires management judgment on the likelihood that the underlying asset will be purchased. So gone is the dollar threshold and in is the judgment. Next, what you might remember as the bright line tests are removed. That is, the thresholds of 75% of the remaining economic life and 90% of the fair market value of the asset. However, using these thresholds as an accounting policy and determining whether the major part or substantially all thresholds are met is one acceptable approach. So I have a lease. It's not scoped out. I've identified it as operating or finance. My next step is identifying my lease term. So lease term is determined at inception, and it is defined as the non-cancelable period for which a lessee has the right to use an asset or underlying asset, including options to the following. You can either have an option to extend the lease or terminate the lease, as long as you're reasonably certain to exercise those options. And we're going to talk about how do you define reasonably certain. If the lessor has the option to extend the lease or not to terminate, it is included in the option. So as an example, you have a 5-year lease with an option to extend, a lessee's option. If you're reasonably certain to extend for another 5 years, you have a 10-year lease. If you have a 10-year lease and you have a right to terminate after 5 years, and you're reasonably certain you will not exercise that option, you have a 10-year lease. If you have a lease and the lessor can exercise the renewal after year 5 on a 5-year lease, you have a 10-year lease. If you have a 10-year lease and the lessor has the right not to terminate at year 5, it's reasonably certain they won't exercise and you have a 10-year lease. So what do we define as reasonably certain? FASB has set a high threshold when it comes to being reasonably certain. So what passes the test? And you're looking at a threshold between 75 to 80% or higher. And if there's a substantial penalty for the failure to renew or extend, you're reasonably certain to extend. If the costs related to the termination of the lease are so substantial, then you're reasonably certain not to exercise. You don't want to take a $50,000 hit to cancel year 5 of 10 lease. And you have to take into account the importance of the underlying asset to the end of these operations. So is this asset instrumental to me doing business? You have to look at the contract renewal rate, and is it below market? And have I made significant investments in leasehold improvements that I can't sell? Did I install an HVAC system in a 3-year lease that has a useful life of 15 years, and I have 3 5-year extension periods? Am I reasonably certain to extend maybe through 1, 2 of those option periods? There will be times when you do have to reassess the lease term. And we'll get it more when you talk about modifications, but lessee should be reassessed only at certain points in time. So if there's been a significant change in circumstances that are within the lessee's control, and that's the kind of key term, right? So if you can't simply reassess the lease term simply because market rates are changing, that's not something you control. If the lessee elects to exercise an option, even though it previously determined you weren't going to do it, or you elect not to exercise an option when you determined you were going to exercise the option, and less likely there's an event written into the contract that obliges you to exercise that option or to terminate. So I know my classification, I've identified my term, I've determined what's reasonably certain to happen. Now I need to know what my lease and non-lease components are. So under the old GAAP, you had rent and executory costs. So you had the cost, rent, the cost to use the space. Executory cost, that is the common area maintenance, utility, those could be fixed or variable. You have insurance and taxes, which are variable and trued up. The change here is under new GAAP, you have to identify your components. So you have your lease, non-lease, and what they call non-components. Your lease components are your rent, the use of that asset. The non-lease components are your common area maintenance, or in a case of an equipment lease, your equipment maintenance. These are costs incurred for goods or services transferred by the lessor other than the use of the actual asset, but they're attributable to that asset. Then you have your non-components. These are reimbursements of lessor costs, so insurance and taxes, or costs that would have otherwise been incurred if the lease wasn't executed, legal costs. You go through legal review of a contract agreement. You incur that cost regardless of whether or not you end up executing that contract. The important thing here and why we have to identify the components is that the lease payments, when we get to the next slide, the fact that they determine the measurement of the lease asset and liability. Current GAAP requires you to separate the lease and non-lease components, whereas the lease components would be used to measure the right of use asset and liability. The non-lease components, non-components are expenses incurred. And you're required to allocate the consideration in the agreement between the lease and non-lease components, which can be difficult considering you might have a gross lease or a net lease. Gross being, I'm paying $5,000, it covers everything. I'm paying $4,000, and I'm also being charged $500 for common area maintenance, an additional $500 for a combination of insurance and taxes. Those are observable and easier to break out. And the important thing to consider here too is that only the fixed portion of consideration is used in determining the measurement of the right of use asset and liability. Now, a practical expedient that can be elected to combine the lease and non-lease components kind of helps reduce that burden of trying to separate the components and allocating consideration between them. More often, we're seeing that companies are going to elect that practical expedient for their real estate leases and not on their equipment leases. On an equipment lease is called like a vehicle. The service agreement is usually more readily determinable and separable from the actual lease component, the rent component. and this is possible because you can make this practical expedient election by asset class. So we're talking about lease payments and fixed and variable. What does that all mean? So your components of your lease payments are broken down to what you see here. Lease payments made by lessees for the right to use an asset during the lease term and used in calculating the lease obligation. A right of use asset consists of following. You have your fixed lease payments. These are the fees per the lease agreement, less any lease incentives either paid or payable to the lessee. You have your variable lease components. Now, these payments may be subject to variability, such as changes in inflation or an interest rate that's applied. Variable lease payments, like I mentioned, only fixed costs are considered in measuring your right of use asset and liability. Variable lease payments should not be included in that measurement, except for payments that are subject to an index or rate. The payments meet the definition of an obligation to you because they are unavoidable. The uncertainty is rather on the measurement, not the existence of right of use asset or liability. So these payments would be calculated using the commencement date rate. So if you have subject to a CPI on day one, you know your rate on day one, you wouldn't project your future payments using estimates of future rate increases. So, and we'll get into a bit more on when we talk about more about the measurement of the liability. You also have your purchase options and termination penalties. So if the lessee is reasonably certain to exercise a purchase option, then that exercise price is included in your lease payment. If you are reasonably certain not to terminate a lease, then that termination penalty would not be included in your lease payment. So you should revisit the reasonably certain criterion as to whether there's an economic incentive to elect these options at commencement date. And finally, these two are probably universally not applicable. Residual value guarantees and fees paid by the lessee to lessor to structure a special purpose entity. We can kind of skip over those for now. I don't think that will add a lot of value for this discussion. So if I know my term, I know my fixed payments, I know how I've classified my lease, and I'm looking to calculate my net present value, right? So if I've got, let's say, 36 months, my payment's $5,000 a month, subject to some increase. My future value, I want to set to 0. The two pieces I'm missing to calculate the one piece I'm missing to calculate my net present value is the discount rate, right? Because we're going to solve for the net present value. What do we use for a discount rate? The initial step in determining the discount rate is to use the rate implied in the lease. So the implicit rate would be considered readily determinable when all the inputs used to calculate the rate are readily determinable. So with the exception of some finance leases, the implicit rate is not likely to be known. In such a case, we go to our next best option, incremental borrowing rate. One of the most common questions that people have regarding the new GAAP is on the discount rate, and specifically the incremental borrowing rate. There's a lot of confusion about which rate to use, where to find the rates, and how to calculate them. So it'd be nice if all the answers to these questions were just clear. Unfortunately, it's pretty complicated. It's not a one-size-fits-all approach to this, and you're going to have to make some judgment calls. The key here is to ensure that you take a methodical approach and document how you arrived at those final numbers. So what is the incremental borrowing rate defined? The technical jargon, the incremental borrowing rate is the rate of interest that the lessee would have to pay to borrow on a collateralized basis over a similar term, amount equal to the lease payments in similar economic environment. It's a lot of words, but basically the focus is what would I be able to borrow at today to relieve myself of my obligation to the lessor? If I have a 5-year lease at $60,000, where could I borrow and at what rate could I borrow $60,000 over the next 5 years? And this is another change in the definition as compared to legacy GAAP, whereby the old incremental borrowing rate definition was defined as the rate you could borrow to purchase the underlying leased asset. So I think there's an improvement there in that many of you are renting office space or your corporate office, or assets you wouldn't typically go out to purchase. Hence why FASB decided to bring all these operating leases onto the balance sheet. You're going to have a different rate. Your commercial rate to borrow and buy a building is going to be different than, hey, what can I borrow to just relieve myself of this obligation? Now, this is difficult, and there are a lot of inputs that go into it. The plus side is FASB decided to make it a little bit easier on non-public entities and permits the use of the practical expedient. You can elect an accounting policy to use the risk-free rate in lieu of incremental borrowing rate. So the risk-free rate is determined using a period comparable with the lease term. If you have a 5-year lease term, what's my 5-year, say, treasury bond rate at that point in time, at the lease inception? When you make the selection, you have to apply this policy to all leases and disclose that fact in the footnote to the financial statement. So now that that's really confusing and interesting, we're going to go to our next bullet question.
Okay, so you should see this appearing on your screen. We'll give it about 20 to 30 seconds for you guys to answer. Okay, it looks like most of the answers have come in, so we're going to go ahead and close that.
Right, as expected, I anticipated a high response to D, needing more information before we can draw a conclusion. This is something where we're trying to put together a little more information on, how we might be able to help, or resources that are available. In our research, there are a number of entities that have popped up, understanding that there's a need. One example that I found was you could pay for a quarterly calculation from a vendor, and they'll only charge you $5,000 a quarter. So there are some interesting variability in vendors who can help you with the solution. As far as electing the risk-free borrowing rate, there are pros and cons, right? The pro being it's easier. You don't have to go through the hoopla of trying to come up with your own IBR. The con is by using a smaller interest rate in calculating a net present value, you're going to come up with a higher net present value. And when you're starting to talk about the lease classification of operating versus finance, and you're coming up with a higher day one value, net present value, and you're looking at the criteria of, is this substantially all the fair value of the asset, in my payments, that is. You may have a distinction where you used to have an operating lease, now you have a finance lease or capital lease. So there are pros and cons. Again, this is an area where we like to spend more time, but with our hour together, this will be a topic that we'll bring up at a later date, push out more guidance as we develop it in-house. Initial direct costs. So as we mentioned on the onset, we talked about the calculation of the right of use asset, and that included the measurement of the liability less any initial direct costs. So there have been some changes as to how those initial direct costs are determined, or what meets the definition. So under previous GAAP, it included any costs incurred regardless of whether the lease was ultimately executed. So you'd have lease underwriting, fixed employee salaries, legal advice, negotiating lease terms, evaluating the lessee financial condition, and there was diversity in practice as to which entities were including those indirect costs or not in their capitalization. Under new GAAP, it's narrowed significantly, so they're defined as costs that wouldn't have been incurred if the lease was obtained. So, for example, payments to a tenant to incentivize that tenant to terminate their lease early. You wouldn't have incurred that cost unless you executed that agreement, or unless you incur those costs and force them out of the space, so to speak. I don't think that this is an area where we'll run into often, but this is one of those, maybe part of the other 10% that we can revisit offline if it's applicable to your unique circumstances. I've gone through my measurement, I've identified my leases, I've got my discount rate, I've determined what my lease payments are. What else might I run into? Another area that we're going to see often, and I think this is definitely part of the 90% that's universally applicable to this group, is lease modifications. What is a lease modification? It is a change to the terms and conditions of the contract that result in a change in scope or the consideration of the lease. Change in scope would be extending or shortening the lease term subsequent to the lease commencement. Change in consideration would be increasing or decreasing the remaining future payments due under the lease. So as businesses grow, expansion into large space might be needed, or it might make sense to extend the term of the lease to get more out of some expensive leasehold improvements. Payments may also change in unpredictable ways if they're tied to an index or CPI. Because these are so common, FASB focused a lot of attention on the remeasurement lease guidance under new GAAP. What do we mean by remeasurement? So here's some additional information on modifications. If you have a modification, it would be accounted for as a separate contract if both of the following are true. If that modification grants you an additional right of use asset, for example, you have Suite 100, you're adding Suite 120. You have an additional right of use asset. And if the lease payment increases commensurate with the standalone price for the additional right of use asset. If you're getting a significant discount on Suite 120, or if your payments increase combined significantly for Suite 100 and 120, that discount or premium might be indicative of payments that are not increasing on a standalone price. You'd have to look at current market rates also. You see you're 5 years into a 10-year lease, you're adding another suite. You could look at the current economic environment for the additional space to determine whether or not that increase in payment for that space is commensurate with the standalone price. If those are not true, if it does not meet these two definitions, then you are otherwise required to reassess and remeasure your lease. So say you we modify the lease of Suite 100 for another 5 years, and instead of $5,000 a month, we're going to say $6,000 a month at an increase of 5% a year. You don't have an additional right of use asset, you still have the same asset. So you're required to reassess the classification of the lease as an operating or finance. You'd have to remeasure the lease liability using the discount rate at the effective date of the modification. So if your discount rate, say you had an incremental borrowing rate of 5% on the onset, 5 years down the road, you modify to the point where you have to reassess and remeasure, and your incremental borrowing rate on that date is 7%. You have to remeasure the right of use asset liability at that rate, at the date of modification. You also have to remeasure the allocation of the lease and non-lease components. And the asterisk is unless you have elected the practical expedience to combine them. So kind of takes off some of the burden on the front end of not separating lease and non-lease components, as well as if you end up modifying the lease subject to reassessment or remeasurement. You may also have lease terminations. Now, this is another area where there has been some change. Under legacy GAAP, the guidance looked at the cease use criteria. And an entity was considered to have ceasing the use of an asset, even if that entity has the intent and the ability to sublease. under new GAAP, that cease use determination is no longer relevant. But rather, entity must determine whether that lease asset is abandoned. Whether or not you have the right to sublease, or maybe you have the right but not the intent, you still have a right to use asset and liability. You still have the obligation. However, it might indicate that you have an impairment of the right of use asset because you're no longer receiving the economic benefit. And I think another topic for accounting for Leases 201 is getting more in depth on this abandonment issue and subleasing. If you have subleases, or you are abandoning leases, you're no longer in the branch, we're out of the space, that's something to make sure you talk to us about. If you're using a technology solution provider, they can also help you walk through that as well. But additional information can be provided and research on that. Financial statement presentation. We have our leases, we've accounted for them, we've modified them, we've terminated, we've subleased them, we've done whatever. What is our impact on our financial statement? So on the balance sheet, obviously the big item is the most significant change being bringing the operating leases that were previously executory contracts onto the face of the financials. Finance leases are going to be accounted for similarly, but will now have a right of use asset and a corresponding liability. The income statement, your finance lease will have amortization expense and interest expense, similar to if you had a capital asset, if you had purchased asset. On the operating lease side, you're going to have a single lease expense line item on your statement of income. And we'll look at an example in a second. Cash flows from principal payments on financing leases or on cash used in or from financing activities. And the interest portion is included in operating activities. On an operating lease, your lease payments are operating activities. And additionally, any variable or short-term lease expenses, if you've elected that practical expedient, are included in your operating activities. So some clarification on the balance sheet. Yes, we have a right of use asset and liability. We've mentioned that a few times. But how do we show it? Right of use asset is considered a non-current asset. And again, it's calculated as a lease obligation plus initial direct costs and less any lease incentives plus prepaid. Your lease liability will be broken down into current versus non-current. So you're looking at the present value of the lease payments not yet paid and determining on a discounted basis what portion is current and the remainder is non-current. You can either present this information on the face of the financials or you can disclose it in a footnote. The important part being you have to separate the finance and operating components. You can't show them both. You may also include your right of use assets and liabilities on the balance sheet within other specific financial statement line items. For example, you might have a finance lease on laptops, equipment, something. You can include that with your PP&E, similar to if you had a purchased asset, and you would call that out in the footnote. One consideration here is lease liabilities are not considered debt. So make sure you're having conversations with your warehouse lenders to make sure that they're aware, as many should be at this point, as they might impact the warehouse covenants. Just from a visual standpoint, here we have our other assets. We're showing our operating right of use asset under other, as well as our finance lease asset. In this particular scenario, they're broken out rather than included in other line items and described in the footnote. Liability side, I have my current and non-current, again, broken out separately, not included in other line items. Otherwise, I could do that and then describe where they are in the footnote. As a visual for the income statement, I have my operating lease expense, my operating leases. This is my single line item for operating. And then in this case, I've included, as you are allowed to do, my interest expense and my finance leases, similarly to how I've recorded other interest expense, and as well as the amortization portion being recorded similar to how I account for depreciation and amortization of my fixed assets. And we have an example that we can send out or discuss offline. These are a couple snapshots. What do the journal entries look like? So at transition or date of adoption, I'm recording my right-of-use asset by debiting my right-of-use asset operating lease. If it's a finance lease, I'm going to, and I didn't change the top screenshot, I'm going to have debit my right-of-use asset finance lease. I'm going to close out any deferred rent. I'm going to record my lease liability as net present value of my future payment. Day 2 accounting, I'm recording my lease expense on my operating lease, and I'm going to amortize off my right-of-use asset. I'm going to pay cash to pay down my liability. And going forward, similar entry, although Day 2 accounting will look a little bit different than Day 1 in the sense of now you have it, if your lease payments are made at the beginning of the month versus the end of the month, your interest will look a little bit different as well. Again, on operating leases, you're going to have a straight line lease expense. That doesn't change. The intent behind the new guidance isn't to change the P&L approach. It's to more so impact the balance sheet. So the straight line expense is still there. It might look different because it's broken out into the amortization of the right-of-use asset, which is not straight line. But then call it the interest portion on the liability, that's not applied to principal, is the other offset to the right-of-use asset. And you have your variable expenses, which are expenses incurred. Finance leases are accounted for similarly to today's capital leases, straight line amortization of the right-of-use asset, and you record an interest expense. This is one area, disclosures, that whether you're developing something in-house or you're having conversations with technology solution providers, or you've had discussions and you need to revisit after this presentation, lease disclosures are substantially changing. And basically they break it down into quantitative and qualitative disclosures. Anything from the nature of the lease, information about the leases, related party, the breakdown of the different cost components or income from subleases. You now have a maturity analysis for both operating and finance leases. The big ones are, I need to disclose my weighted average remaining lease term across all leases separated by finance and operating, as well as my weighted average discount rate separated by operating and finance. This is a significant task to undertake. Technology will help. I find myself somewhat savvy in Excel, and this is something that it starts to get difficult when you're trying to track in spreadsheets. You also disclose any accounting policy elections on, say, short-term leases, or whether or not you're going to separate the lease and non-lease components. What does that look like? So the quantitative disclosures can be broken down into 4 different buckets. You have your lease costs. You have your those are attributable to entering into lease agreement. That's the expense. You have your other information, which is basically presenting the cash flow and supplemental cash, non-cash information related to the liabilities, broken down between operating and finance. This is a screenshot from FASB's guidance. You can pull up AC guidance, pull up the FASB authoritative literature, and these are in there. There are also some public companies who've gone through Q1 and Q2, which is nice because we have some examples you can follow, kind of best practices. You also have your weighted averages, as we've mentioned. That is the lease term and discount rate separated between finance and operating, and then maturity analysis. So this is the undiscounted cash flows per usual, but then reconciling to the lease liability on the balance sheet using the discount rate. So going through that fairly quick, we talked about some of the challenges. We're going to get to our polling question number 3 before we get into some of the wrap-up items.
All right, we've launched that poll question. If you can please log in your answer, we'll give it a little bit of time. Okay, it looks like most everybody has voted, so we're going to go ahead and close out this poll question.
As expected, the resource needs and costs associated with adoption, if I had to guess, that would have been the highest, and it was 48%, especially when public companies are having so many issues with all the resources at their disposal, whether it be knowledge, money, bodies. If they're having issues, and we start breaking it down to entities who may tend to be more limited when it comes to resources, there are sure to be some issues, which I think FASB has recognized and is why they pushed out, or should push out, the adoption for another year. Identifying embedded leases and explaining the balance sheet to the user of the financial statements are neck and neck. Hopefully we'll have some discussions with warehouse lenders and they'll all get on page. It's a small world, this industry. So before we, I think we have about a little less than 10 minutes left, so in our time together, we're going to run through some practical expedients, some issues that public companies were having, and how you can prepare going forward. The first, I call it a set of practical expedients, is affectionately called a package, because this is an all or none election. You either elect all three or none of the above. Predominantly, in talking with other vendors and companies, 100% of the time, the package is being elected. And what does that do for you? So the first one is you do not have to reassess the lease classification. So if you had a capital lease, it's a finance lease. If you had an operating lease, it's an operating lease. You don't need to reassess whether any expired or existing contracts are or contain leases. You've made the decisions under the new guidance. You don't need to go back and revisit, well, do I meet any of these? Do I have to revisit? Do I have to reallocate? You do not. And you also do not have to reassess the initial direct costs for any existing leases. So as we talked about, the definition of an initial direct cost has changed. It's now much more narrowed. And if you have previously capitalized them with your capital leases, great. You don't need to reassess whether or not you should have. So one thing you cannot grandfather is errors, but I think everyone on this call, I think, has a good sense of their leases, whether it be equipment or retail space. We've done a great job of reconciling everything back to trial balance for as far as rent expense. We've had discussions in the past. We should be not having any issues with the grandfathering of errors. The next practical expedient is the expedient for hindsight. An entity is allowed to use hindsight in evaluating options to extend or terminate, or to purchase the underlying asset if it's a capital lease, in determining the lease term and reassessing impairment of the right of use asset. If not elected, the company will continue to account for the leases the same as prior to the adoption of AC 842. For the most part, we are seeing this not being elected because it involves a lot of work to go back and visit, especially a large lease portfolio, to reassess the terms of options to renew or terminate. Another big win by FASB. Originally, the guidance required a modified retrospective approach in that you'd have to adopt the new guidance effective as the earliest period presented. Thankfully, now you can elect not to do that, and your presentation can begin in the year of adoption. So if you're early adopting this year, you don't have to show the prior year presentation for asset and liability. And although you have the option to, if you do, then you have to go back and use the discount rates that are in effect as of the beginning of the period presented. So it gets a little bit more confusing. More often than not, people are electing to adopt to reflect their balance sheet, asset and liability as of the period of adoption and not the earliest period presented. The next few, these are policy elections. We've covered these. You have an election to combine the lease and non-lease components You can elect to exclude short-term leases, those are 12 months or less, generally, from your calculation of the lease asset and liability. And as we mentioned, non-public entities have the election to use the discount rate, the risk that's equal to the risk-free rate at the point of lease commencement. Real quickly, issues that public companies have had. Identifying the complete population of the leases. We talk a lot about the embedded leases. That we could have a separate 1-hour CPE class on that. Identifying the required lease components can be difficult if you've got your gross or net lease arrangements and you have a large portfolio. Determining your incremental borrowing rate has proved to be difficult. Establishing processes, policies, and controls. This is something where if you previously had everything in Excel and Excel is no longer viable, or if you have a small number of leases, maybe Excel is still viable, but you have to understand there are some issues with change controls. There are a lot of things that technology will allow you to do that Excel won't, to make sure that you have a solid set of controls in place to make sure that your lease asset and liability are accounted for correctly. They've had issues with software and technology implementation. The transition accounting may have been great, but as 842 was rolling out, we saw a lot of vendors come into the market and say, I have a solution, but they may have rushed too quickly and not consider day 2 accounting. So we've had a lot of people revisit either with the current vendors or new vendors, and having issues also with some of the disclosure requirements, which have been increased significantly. So how can you prepare? One of the big ticket items is identifying and deploying a technology, whether that is developing something in-house or creating policies, procedures, controls on an Excel template. Great. But what is going to be the highest and best use of your people, your resources in rolling out a technology solution? Assessing your required resources. Do I have the people? Am I allocating a budget if I'm going to go external? What budget do I want to allocate, or do I want to purchase administrative services or accounting services? Maybe the accounting services will take care of the lease administration in-house. Pull in all of your service contracts and review for embedded leases. Make sure that you get those leases on your updated lease inventory. Now you have a complete set of data at which you can identify data gaps. You have to identify your interest rates. Do I need any other information in order to record my lease asset liability? What's the impact? I need to talk to my warehouse lenders and make sure that my covenants aren't going to get blown because they understand that this is not debt. Do I need to change and revise my controls, policies, procedures? How am I going to extract and store lease data? Doing something now prior to the rollout in 2021 will be important in setting up for success, given that you have about a year or 4 months to do so. And then this isn't just to let it sit. It's going to require a lot of review and revision for ongoing compliance, considering this isn't just now I'll just plug it into an Excel file. I'm going to run my deferred rent, and I'll just adjust to match that every month or reconcile every year. So there's a lot you can do now, and this is also something that we can discuss offline and make sure that we are having constant dialogue to make sure we're prepared for 2021. With that, that was a lot of information in an hour and probably some information that you did not get, and I understand. I'm hoping I covered 90% of what's important. I'd really like to have some examples to discuss. Please submit your feedback, questions, so that we can push out frequently asked questions, some question and answers, and we can gauge interest on setting up a separate webinar on maybe walking through some real-world examples with real numbers. And again, thank you so much for your time and attention, and I look forward to talking with you all.
Great. Well, thanks again. Again, just a couple reminders. We will get to your questions if you all typed questions in. We do have those recorded, and we'll get followed up on those directly to you. We will also be sending out a recording of today's webinar along with the slide deck. Please look for that in the next day or so. And for those of you who are looking to earn CPE credit Those certificates will be sent to you, to all who qualified over the next several days, also via email. You will receive the slide deck again, so if you did not type your questions in, you will have Charlie's contact info, and look for those emails soon. Thanks again for joining us. Goodbye.